Welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for the AI Technology Conference. The next presentation is from Carrier Connect Data Solutions. Please note you may submit questions for the presenter in the box to the left of the slides. At this point, I'm very pleased to welcome Mark Binns. He's the Chief Executive Officer of Carrier Connect Data Solutions, which trades on the OTCQB venture market under the symbol CCDSF and on the TSXV under the symbol CCDS. Welcome back, Mark.
Thanks, John. Great to be here today. Welcome, everybody. We're going to talk about data centers today. I know this conference is about AI, and this is a big reason that I'm in the data center industry. Perfect place to start. I'm going to tell you a really exciting story about this company. Show you how we're executing, show you how the shareholder value has been created in the model that we're running. It's a very repeatable, profitable business with a ton of alpha and a ton of growth in it. But to get there, I'm going to talk about sort of where I came from a little bit. So I'm a 5-time public company CEO. I know what I'm doing, experience management. I took a company from 3 cents and $3 or $4 million market cap to $5 a share and $1 billion market cap. Both on the venture and on the QX. And then I exited, I did some consulting, and I started some CPCs. And one of my capital pool companies, which is a Canadian version of a SPAC, I said, it was called Hopefield Ventures 2. And I said, I want to find a deal in the AI space, in the AI space broadly. And with a meeting with my lawyer, who was running the company, I said, do you have any ideas? And he said, look at data centers. That's the infrastructure play of AI. It's the picks and shovels play of AI. And I said, that's a great idea. And I went and I toured some data centers and I started doing some research. And what I found were a bunch of charts that look just like this, with hyper growth projected in the data center industry. And when I get into a new industry, I want to be on the front end of it. I want to see a big macro movement where a lot of wealth can be created. I do want to be early in the industry, and I need to find an opportunity. So, as soon as you look at the chart, you see, okay, data center growth is expected to go very significantly over the next number of years. And what is the reasoning for that? And this is about AI. So AI is driving massive compute power requirements. And, if you ask ChatGPT a question, I'm told it's somewhere around 10 times as much processing power is needed versus asking Google the same question. 10 times as much compute power means, in aggregate, 10 times as many servers. Servers are just the computers on the back end that process those requests and queries and crunch all the data. And a server lives in a data center. So for corporate needs, like at home, your server, your computer just sits under your desk. But for corporate needs at scale, that's not nearly good enough. They have to sit in a data center, and a data center is where they're hooked up to space, power, and cooling. In this picture in the background, what you actually see is a rack, it's called. It's a steel frame. It's 2 feet wide. It's 4 feet high. Sorry, it's 10 feet high, and it's like 4 feet deep. And inside of it, all these little lights you see here, these are servers. And they're in a data center. You are providing basically the space for a company to come plug in their servers. You're providing power to turn them on and power them up and run them. You're providing cooling to keep them cool, because servers and computers generate a lot of heat when they're running, and fiber optic connectivity to the internet. And then you have power backup systems, which is really important. So the power can never go off in a data center, because then all the servers would turn off and whoever's business is in there running would go down. If QuickBooks was your customer, someone tries to log into QuickBooks, it wouldn't work if their servers are offline because of a power outage. So there's backup power battery systems, UPSs. And then every data center has what they call a genset, which is a diesel generator or multiple diesel generators that can kick in and run indefinitely to keep the data center running. So that's what a data center is. I toured some data centers and I'm like, this looks like a good industry, and I'll tell you some more stats about it, but it's the infrastructure play. We do not sell servers, and we do not even manage the servers. We are like the self-storage company for servers. You come as a company, your IT team comes, plug your servers in, you manage your hardware, you decide what hardware you're running. We give you the space, power, cooling, backup systems. We're the infrastructure. So that's the data center industry. Every server in the world lives in a data center. Even Amazon Web Services, all of their servers that run AWS live in data centers. Some cases they own them. In some cases, they rent space in other people's data centers. So I said, okay, I toured some data centers. I did some research. This industry looks amazing. I'm going to take my CPC and I want to go find a data center to buy to start to get into the industry. But I needed to understand what the business model was going to be to really create significant shareholder value and create wealth. And it's not by just having one data center or taking one data center public. So through some time, research, talking to data center owners and operators, we settled on an investment thesis and a strategy that's been playing out extremely well. We've been public, I think it's 1 year today, actually. I think it's our anniversary of trading. And we've created a lot of wealth. I'll show you the chart in a minute. But what we determined is there's a big disconnect between private company valuations of single location data centers, so just one data center that's owned by a private company, and public company valuations of portfolios. So a public company worth more than a private company, but having a portfolio of 3, 5, 10, 20 data centers is way more valuable than just one. Part of the reason is customers can then put equipment in multiple data centers in different locations for data backup, data redundancy, disaster recovery. There's all sorts of value that's created and more revenue that's unlocked if you have a portfolio. So we started looking at what are these valuations. On the public company side, they range from 10 to 25x top line revenue. At the absolute most conservative, it's 10 times top line revenue you see in the public company portfolios, and much higher in some cases. The private company valuations, as we looked and discussed and negotiated what we could buy data centers for, run somewhere in the 2 to 3x revenue, and there could be even better deals than that. But if we said 2.5 times revenue as an average, and then we said the public company ones are worth 10x on the low end, very conservatively, that means I'm getting a 4 times lift on every dollar invested. So every dollar I raise or invest in buying data centers and putting them in my portfolio, I get $4 worth of market cap. That is a very good business model and a very good return. A couple more things around data centers is they're very profitable. When they're full, they run as much as 40% EBITDA, and the customers never leave. IT teams put their equipment in the data center. As long as it's powered up and running, they don't want to go anywhere. They don't want to turn it off. They don't want to move it. They don't want risk of downtime or problems for their customer base. So the churn rate in data centers is less than 1%. We have a data center company in Ottawa as part of our portfolio now. They've been around 8 years. In 8 years, they've only ever lost 2 customers. In Vancouver, where we have a data center, we have customers that go back 15 years in the same data center. It's a very sticky, very highly profitable business. There's no people. You walk around data centers, it's just hardware humming along, generating revenue and wealth for the owners. So I said, let's go start buying data centers and rolling up this industry. And by the way, I should say, we're looking at the small and medium sized data centers in the industry. They run somewhere between $1 and $10 million in annual recurring revenue. They're probably 5 megawatts of space or less. There's 325 data centers in Canada. There's 5,400 data centers in the US. At least 2/3 to 3/4 of them fit what we would call tier 2 or tier 3 small to medium sized data centers. This is where the opportunity exists because we can buy those data centers. The big data center companies, they're at the low end, $10 billion market cap companies. At the higher end, like Digital Realty and Equinix, are more like $80 to $100 billion companies. These are great data centers, but they're not going to buy them. They're not big enough. Those guys are bigger, more concerned about building out football field size hyperscaler data centers. You hear about those in the news, but that is a very tiny part of the actual market. Most of the data center market is small to medium sized data centers spread across all the major cities of North America and the world. So those are the targets for us. First data center we bought was in Vancouver. It was called Carrier Connect. It's part of how our name came to be, Carrier Connect Data Solutions. A carrier, if anyone is running or wondering, is like an internet service provider, like AT&T or Verizon or Rogers or Bell in Canada. Those are carriers, and you put your equipment in our data centers, you get connected up to the internet through those guys. In Vancouver, it's 50 racks. It's a small metro data center. It does about $500,000 a year in revenue. It was profitable. It was pretty much full, between 80 and 90% full. This was a perfect data center to go public with for our qualifying transaction because I didn't have to raise any money to do it. It already had assets, customers, cash flow positive, revenue, et cetera. Even though it was very small, it would make no sense on its own to have this as a public company, but it was a perfect way to start a portfolio and keep a tight cap table, which you'll see later on. Then we bought a data center in Australia called Nexion W1. It's much bigger, 220 racks of space, 2 megawatt facility. We paid 2.5 million Australian for it, but we only paid 300,000 in cash, and the seller did the rest on a vendor take back. It makes 65,000 a month in revenue. It's profitable the day we bought it, but the best part about it is that it's only 20% full. It was actually owned by a company that was doing software M&A. They were buying a bunch of software companies. One of the software companies they bought just happened to own a data center, so they ended up with a data center. They didn't know anything about owning, operating, or running data centers, nor did they want to. So they wanted to get rid of it. And in fact, they had a competing investment in Australia around the fiber ring that goes around Australia. So the regulators halted their stock and said, you've got to get rid of one of these. So they decided, oh, well, let's get rid of this data center. So we were an amazing, I guess you'd say, opportunist recipient of this deal, where we only put $300K in cash in it and came out with a data center that would take $20 million to build. Data centers take about 10 million a megawatt for a new tier 3 data center. The hardware in it, we estimate, is probably worth about $6 million if we just shut it down and sold the generators, the chillers, et cetera. So 2.5 million, where only 300,000 was our cash cost, was an amazing deal. And we have the revenue potential in this data center with no new CapEx to do 4 million a year in revenue. That is $1.5 million in EBITDA. Incredible asset. Then we bought a company in Ottawa called Pure Colo, 2 megawatt data centers. One is in the tech park in Canada on March Road. The other one is out on Riverside Drive by the airport. These is an amazing company. It was built over 8 years by a group of entrepreneurs, bootstrapped. We paid $8.5 million for it, mix of cash and stock, right around 3x top line revenue, just a little over. They're probably doing 2.3 to 2.5 million in annual recurring revenue. It would take $40 million to build it from scratch right now if you built it new. And it has the potential to do $6 million a year, or with our multiple, $60 million in market cap and potential. Again, it's 2.3 to 2.5 million now. And when we bought it for $8.5 million, we got re-rated to the expected value of it of $25-ish million. And I'll show you that in the chart. It's a very direct drive to us buying these assets, putting them in the portfolio, and getting re-rated in terms of the valuation of our company and the market cap, which is by design from day one. The fifth data center that we have an LOI for is in St. John, New Brunswick. It's owned by Carbon 60. They run basically managed services, IT services, and they do that all over Canada. And they use other people's data centers for their hardware, except for they had their own in Atlantic Canada, but have decided that it makes more sense for them to be tenants in other people's centers because it's not their core business. This is one of the ways we can buy data centers, is we're buying it from companies where it's not their core business. A data center company is not going to sell us a data center, at least not likely, or not one we want. But if it's not their core business, it makes a lot of sense for them potentially to divest and then lease back space from us or something along those lines. This is a facility. It's about 0.5 megawatt. It's got 3 different data halls in it, 20 customers. We're buying it for 1.7 million, 1.75 million in cash, and it should close by roughly the end of this month. Could be worth as much as $18 million or more in market cap for us. All the data centers we're buying are in the break-even or cash flow positive range. They have they don't need capital expenditures. That's a big thing where we've seen lots where you need to go in and rebuild all the generators or buy new chillers. We're buying stuff where all the CapEx is done. And ideally, the third tenet is they have space, which allows us to expand in the footprint without putting out new capital investment. If we find those 3 things, they're good targets for us, and we buy them and add them to the portfolio. So we have 4 plus 1 under LOI. I made this chart a year ago, February 2025, when we went public, and I said, well, by the end of the year, I'd like to have 2 more data centers. We actually had 3, so we finished the year with 4 data centers. The guidance for this year is that we're going to buy 4 to 6. We have the first one announced in St. John. we'll see, but the pipe is looking really strong. We've been talking to a ton of owners, operators, corporations that own these target size tier 2, tier 3 data centers. We can probably beat that. But even if we add 4 to 6, that means we double or 150% growth on our revenue, size, and market cap. Then we figured in 2027 we might start building data centers. Our thinking now has changed because the plan is executing so well that there's no point in building new data centers and taking 2 years to build them and then putting customers in them when we're buying these companies full of customers, cash flow, that don't require new CapEx, and we're getting re-rated and getting that essentially ARB value for our shareholders. So as long as the model's working, I think now we're going to stick with buy and add to portfolio. I talked about my own history a little bit, so I won't really dig into that much more. John Arnett is our CTO, very, very experienced data center owner operator. He owned the data center in Vancouver that I bought to start the company called Carrier Connect Systems. I said to him, it doesn't make sense for us to take one company public, but it makes a lot of sense to go do this roll-up strategy. If you want to be part of it, I need a data center guy. And he said that was the only way he would do it. So I have a great partner in John. I've got the capital markets, capital raising side. He knows how to run, a giant electrical cord or wire through a data center to power up a rack. I'd probably electrocute myself. I have a technology background, but he has the data center specific expertise we need. So that's awesome. Two great guys on the board, Mitch Demeter, who actually helped me build Big Digital Assets back in the day. He basically is retired and sits on boards now and has a great network, great connections, great sounding board for me. And Peter Smirniadis, who is a director at Victory Square Technologies, which is a Canadian early stage public company that does incubation of early stage tech companies. So it couldn't be a better guy to help us along the way. And I have one capital markets advisor, just one advisor total, Dan Barnholden. Him and I actually incorporated or started the CPCs that became the current company. He's a CEO of Luca Mining for about the last year, taking it from somewhere around 30 cents to $2. But he was a banker his whole career. He's extremely well connected, raised over $1 billion in financing for companies he's worked with. So everything tied to capital markets, we have a really great partner. So cap table, I talked about this early on about not doing concurrent financing on our QT. We've kept it really, really tight and well controlled, 25.4 million shares. You'd often see 80 to 100 million shares out for a company at our phase at this point, but we don't because we didn't need other people's money to start with. We came in with our own capital. Insiders own 18%, give or take, of the company. There's only about 9 million shares actually free trading. And we have a really good shareholder mix. We have probably 18 to 20% insider, at least 20% institutional now. We have a number of long-only brand name funds that have already bought the company. And then we have 60% retail, but a lot of our retail have major holdings, many hundreds of thousands of shares, long-only guys that are here that want to see actual wealth created. And here's the chart. And I know everybody can look up a chart, but what I'm showing you is the results of acquisitions. So we went public, we get valued for the first data center in Vancouver, and we basically said we're going to buy a data center in Australia, and you see the stock went up, said, oh, that's going to add value. And then we went through the legal process, we closed it, and we got essentially re-rated for that value. Then we went through the summer a little bit, some bumps, and we said, hey, we're raising capital. And stock always sort of sits flat when you say you're going to raise capital. And we announced we're going to buy this Ottawa acquisition somewhere in here. Then we closed the capital, and the market went, oh, they're going to actually, fulfill on this next acquisition, this significant acquisition. We announced that we closed it, and we were re-rated for the value and the revenue of that acquisition. And then we announced that we're going to buy this St. John, and the stock is sitting right about here now as we close it end of month, and then move forward with the additional data centers that we have in the pipe. And we are very close to multiple future transactions on those in negotiation. I expect we continue to get valued and re-rated, of course, based on our revenue and the multiples that we work with. Catalysts, closing data center acquisitions. Obviously, right now, the goal is acquire data centers 5 and 6. Number 5 has been announced, St. John, New Brunswick. 6, 7, 8, 9 are all in negotiation. We have a deep funnel. People ask me all the time, is there enough data centers to buy? Absolutely. Remember, there's 325 in Canada, 5,400 in the US. We believe around 2/3 of them fit our target profile. It's a very fragmented, fractured industry. There's the very big players at the top. The smaller guys are $10 billion market cap. The bigger guys are $100 billion market cap. But there's no one out there, and we haven't run into anyone else that's been rolling up this sector yet. I think there'll probably be copycats, but so far we seem to be the only play. We're early in it. I like to be early in industries, early in movements, as I said. And as we build this portfolio, it becomes very attractive to the potential acquirers out there, like the Cologix, the E-Structures, the TeraWulfs, the data center companies that aren't going to buy these one at a time. They're too big. But when I have a portfolio of 10, 15, 20 of these data centers, they absolutely would find that very attractive. So keep acquiring data centers. We have the US listing, obviously, that's why we're here. CCDSF. We're going to start doing a bunch of marketing in the US. This is one of the first sort of outreaches. We believe this story is going to be very easy to understand and well received in the American investing public, I guess you'd say. I have a really good network in the US from previous companies and previous success, family offices, funds, broker community. We're going to tell this story to, and you could have the best company in the world, but if you don't tell anyone about it, they can't buy your stock. Obviously, fill up the space. The primary driver of fast value creation is the acquiring of data centers, but we are looking for ones with space that we can fill up and get accretive value. So we have space to fill. As I mentioned, in Perth and Ottawa, Vancouver's basically full, but that allows us to do customer announcements, add top line revenue that drives market cap without any significant capital expenditures. And then finally, as I said, tell a story, investor outreach. I sort of talked about the US, but get out there and let people know what we're doing. And when they know what we're doing, they can invest in us. So very simple to understand. Basically acquire single location private data centers, put them in a public portfolio, grow the revenue with inside of them. Repeat. We raised or spent, so some of it was from Treasury, but around $11 million last year, and got a market cap in the $50 million range out of it. So our goal of returning 4 to 5x for dollars invested has been holding perfectly. So that's what we continue to plan to do. I'll come back to this at the end, but my contact information is here, marketcarrierconnectds.com. Don't be shy to reach out. If you have questions, you can obviously reach out. We'll do our best to get back to you as we can and answer. There's lots of presentations online, and you can find us out there. I'm going to pull up the Q&A and go through them. What would make CCDS attractive to future acquirers? Some scale and geographically diverse locations. So, at 10 data centers plus, and having locations, right now we have West Coast Canada, we have Central Canada. We're going to have an East Coast location in New Brunswick soon. We are looking at American properties, and we do have international properties, and we'll probably have more in Australia. If we have those, that makes people very interested in acquiring us because we have a diverse location base that they can put customers into and sell in a whole bunch of locations. Revenue stream certainty again with multiple locations, but at 10 plus, we become very attractive. How do we distinguish our company from other players in terms of target customer service mix, et cetera? We are tier 2, tier 3, mid-market. We have customers like Dell, Nokia, Wind River. We have a lot of brand name customers in our data centers, and all the way down to small companies that people haven't heard of. We offer customized and personalized service for one thing, right? Like we'll have a AI customer come to us and say, I need direct liquid cooling, I need plumbing to this part of the data center. And we'll say, well, this is the cost and we'll do it for you. And then they'll say yes, and we'll do it. Other data center companies we know will say, no, that's not part of our model. You got to fit in the racks the way we have it, or you can't be here. So we're a bit more nimble and responsive, and we have attractive prices as well. We're below the most expensive guys in the market, but we're in the meat of the market. If you have a triangle of business, we're attacking and servicing the bottom 2/3 of the market. How are you prioritizing geo footprint of the 6 data centers you're targeting located in Canada? The ones we're targeting are Canada and not Canada. We are looking at American assets, we are looking at Canadian assets, and we're looking at international assets. We do like to be spread out. That's why we're adding in St. John, New Brunswick, for example, and where we will add in the US, because I believe it makes us more valuable to acquirers. Let's see. You just upsized a private placement to 10.5 million. How does the larger raise change the scale of acquisitions? Yeah, it's a good question. More money gives us more fuel to move faster, right? And to have help on the M&A side, which is a tedious and busy task, and also be able to do more deals. So I think we have done successively larger raises at successively larger prices, and we will continue to do so, and then put that money to work in acquisitions, which will be accretive to the bottom line and to our shareholders. We try not to over raise money until we need it as well, because we don't want dilution unless we can put that money to work. I am and John are the 2 largest shareholders of the company, so we're very focused on creating value as a part of a share price, not just total market cap where the share price doesn't move, but it's definitely going to let us move quickly. Someone said, how are you funding your data center acquisitions? We recently announced a financing, so that was one part, but there's creative ways to do financings, or not financings, but acquisitions. We have done vendor takebacks where the sellers actually do a part of the financing. We've done stock. We've done stock and cash, I should say. We've done straight cash. There is even other potential acquisitions where there's royalties or get paid on the back end instead of upfront, depending on how the data center performs. So there's a whole mix, and debt is a significant part of it. We get put into the real estate group by lenders, and as we have an ever-growing asset base, because these data centers are asset heavy, then we can borrow against that asset base for security and do acquisitions through debt, which is totally non-dilutive entirely. And again, because they're cash flowing businesses that we're buying, lenders like banks will give us straight debt financing. So it'll be a real mix, and we try to make sure that we keep dilution to a minimum. As you saw, the cap table is something I'm very proud of, and we'll try to keep that in check. But really, for every dollar we raise issue, if we can return $4 or $5, then we're fitting our business model. B&M Bloomberg feature highlight our role as an AI infrastructure roll-up. What are you seeing in terms of inbound demand from AI and high density workloads? It's absolutely there. We've been adding AI customers along with traditional compute customers, which are the bread and butter of the industry and of our data centers as well. But there is inbound interest from these, higher capacity type of customers, and they're looking for space, but they also need power. And I should mention power. In our data centers, we have all the power already allocated that we need to fill up the data centers. That's why building can be a challenge, because you have to get the power, and you may have moratoriums in certain markets on new power. But if you're buying an existing business full of customers, a data center company, the power has already been allocated years ago. And the more power customers use in those situations, the more money we make. So if an AI customer uses more power, we make more money because we mark up the power. So it's a pretty great business model for us. Given interest we're seeing from the broker community, do you see a path to broader institutional coverage? Absolutely. We will have, I believe, research coverage coming down the road. We are getting a lot more inbound. We've had research companies just call us recently and say, hey, because we're getting on the radar now of the investment community, the banking community, and they want to do research on us to cover us. So I believe we're going to have that coming. And we'll start getting included in, the conversation around data center. There's data center magazines and articles and all this different stuff that we're definitely getting a lot of interest from. And I'm going to stop there. So, we're at our half hour. Again, I'm going to put up the slide here at the end. So Market Carrier Connect, ds.com. I thank everybody for coming. We're we're really excited about where we are, but even more about where we're going throughout the course of this year. And we welcome everyone to come be part of the ride with us, CCDSF on the OTCQB. Thanks very much.